معرفة.
Bismillah ar-Rahman ar-Rahim. In this lesson, we will discuss about working capital finance. Basically, as we have discussed earlier, a company has various financial needs. And in cases wherein a company needs cash to fulfill various financial needs. Now, to address this concern, there are certain structures which are used by Islamic banks to provide financing to different corporates. The first structure, which is quite common, is called as Commodity Murabaha. Which is also referred as tawarruq. This is one of the most common methods through which financing is provided to corporates, and the corporates would get liquid cash through this type of financing. The second structure could be the Mudaraba. This is not a very common structure, but some banks do provide working capital requirements through a Mudaraba structure. And maybe the third could be through a Wakala. Okay, so as we have discussed, there are three main structures which are used to provide working capital financing by Islamic banks. One is through the Commodity Murabaha, which is also commonly referred to as tawarruq. The other is the Mudaraba, and the third is the Wakala. Mudaraba, of course, we have discussed the structure of the Mudaraba earlier, but we will see how Mudaraba is used to finance corporates. And then the Wakala is again an agency structure, which is also used sometimes to provide financing to corporates. So all the working capital requirements could be addressed through some of these structures when they are used to provide, when these structures are used to provide financing to corporates. Now let us start with the Commodity Murabaha structure. Okay. Now this is a simple Commodity Murabaha structure, wherein what we see is that this is the corporate, for example, and this corporate requires liquid cash to address its financial needs. Now, in a Commodity Murabaha structure, what we see is that there is an Islamic bank, there is this seller 1, there is this purchaser to whom ultimately the assets or the commodities are sold for the liquid cash. So let's understand the flow of this structure. For example, if this corporate or company requires a financing of $10 million. So this corporate approaches an Islamic bank. And the first step is that this corporate provides a promise to purchase to the Islamic bank, mentioning that in case of the Islamic bank purchases certain specified goods or commodities, then this corporate would in turn purchase those goods or commodities from the Islamic bank. So this in a way gives certain comfort to the Islamic bank to go ahead and make the purchase. So this is the step number 1. Some institutions require this and some institutions do not require this, but generally there is this promise to purchase in this structure. For example, so once the promise to purchase is given, which is a unilateral promise given by the company to the Islamic bank. The step 2 is, for example, if in the promise to purchase, the company has mentioned that the company would purchase certain identified assets from the Islamic Bank of value $10 million. Then the Islamic Bank would go ahead and purchase those specific commodities or assets from a seller. Now this could be a broker, this could be anybody in the market who sells these commodities or goods. Now, so what the Islamic Bank does is the Islamic Bank makes the payment, and these assets or commodities are transferred to the Islamic Bank. Now, one important point which we have to keep in mind is that when this purchase is done, these assets have to be very clearly identified. They have to be quantified. These assets have to be in the possession of the seller, and these assets have to be properly transferred. So the risk has to be transferred to the Islamic Bank. In terms of the possession, of course, it could be constructive possession or it could be actual possession, but the ownership of the assets have to be transferred to the Islamic Bank. In terms of the nature of the assets which are generally used in commodity murabaha transactions, they are different, and it also depends from region to region. Generally, in big ticket commodity murabaha transactions, we have seen that metals are used. We have also seen that in some geographies, for example in Malaysia, they are also using palm oil, for example. And in some other geographies, some other commodities are also being used. So what we are trying to say is that in the nature of the commodities could vary from region to region, but in a nutshell, whatever the commodities are, the basic principle is that these have to be properly identified, and the risk of this commodities have to be transferred from the seller to the Islamic Bank. So this is the step 2. Now, once the Islamic Bank owns these commodities, then through a murabaha, these assets are transferred to the company. Right? So for example, if the Islamic Bank has purchased 10 million worth of commodities, then the Islamic Bank is selling that 10 million worth of commodities to, for example, to the company, adding its profit margin of maybe $500,000. So 10.5 would be the sale price of the commodities which is being sold to the company. Now the company through in a murabaha could agree that this payment would be done over a period of 5 years. Fine. So once this murabaha is entered into, then now the company is in the ownership and is in the possession of these commodities. Now this company, what the company will do is that this company needs cash. This company is not requiring the commodities. So what this company does is that this company would sell these commodities to another purchaser. Now this purchaser has to be different. This purchaser cannot be the seller. They both have to be total different legal entities. That is one of the basic and the main requirements in Sharia, that you cannot sell these assets back to the same seller from whom it was purchased. So this entity needs to be different completely. So this is an important point which needs to be understood. So what will happen is that, so for example, if 10.5 was the sale price of the murabaha, then this company will, for example, sell these commodities for 10 million to the another third party purchaser. And this third party purchaser will make the spot payment. So now the company has received 10 million worth of cash. Right? Now this 10 million worth of cash the company can use for its working capital needs, and then the company has to make the periodic payments until it pays the whole 10.5 million to the Islamic Bank. One important thing which needs to be kept in mind is that the IOF has a very clear guidelines that the company should not appoint the Islamic Bank to on sale these commodities which the company has purchased. So what it requires is that the company either directly sells it, or the company can appoint any third party agent to sell on the behalf of the company to the third party purchaser. But the company should not appoint the Islamic bank in the second leg as its agent to make this sale transaction. So this is an important point which one has to keep in mind. So the four important things which I think which are important in a commodity murabaha transaction are as follows. The first point is that when the Islamic bank purchases the commodities, these commodities have to be properly identified. The risk and the ownership of these commodity has to properly transfer to the Islamic bank, and this of course has to be a Sharia compliant commodity, and this is the principle number one. Number two, when there is a Murabaha sale transaction between the Islamic bank and the company, in this Murabaha sale, the principal and the profit has to be explicitly disclosed to the company. Meaning to say, if we are taking this example, the Islamic bank has to clearly mention that the 10 million is the principal and 500,000 is the profit, which the Islamic bank would put in the structure, and that has to be very clearly mentioned in the Murabaha agreement. Now this is the second main point which we have to keep in mind. The third point is that when the company has purchased the assets through a Murabaha, then the company should not appoint the Islamic bank as its agent to sell these commodities to a third party purchaser. So the company either should directly sell it, or the company should appoint another agent to facilitate it to sell it to the purchaser, but it should not appoint the Islamic bank. Some scholars have permitted that the Islamic bank could act as a messenger, meaning to say the Islamic bank could facilitate the offer and acceptance between the purchaser and the company by just forwarding it to the purchaser. So the role would be just merely as a messenger, but not as an agent, meaning to say the Islamic bank will not sell it acting as an agent of the company, but it will just take the offer and acceptance between the company and the purchaser, and that is why it is just acting as a messenger. So some scholars have allowed this in some institutions, and this by doing so they would not be violating the principle which is clearly mentioned in IOFI, that the seller should not be appointed as an agent in the second leg to on sale the commodities which the seller has sold to the purchaser. The fourth important point is that there should not be any relationship between this purchaser and this seller. They both have to be two distinct legal entities. So you cannot purchase it from the same seller and then sell it to the same seller. No. So if the Islamic bank has purchased from the seller 1, it has sold to the company, and the company has to sell it to a third party purchaser. The Islamic bank should not sell it to the same seller from whom initially the commodities have been purchased. So this is then another important principle in a commodity murabaha.